Assalamu alaikum students, this is your teacher Azka, and today we are going to talk about the liquidity ratios, and this is the part of your O levels and A levels accounting syllabus. And um, there are basically four types of liquidity ratios which we are, you can say, that use in real in different companies. But in your syllabus there are only two type of liquidity ratios. The number one is current ratio, and the number two is acid test ratio. So basically, what is liquidity ratio is a measure of the ability of a business, that business is whether capable to pay its short term debts or not. For example, if business have some kind of obligations, maybe business have some kind of trade payables. So liquidity ratios tells us that whether or not business have current assets to pay its short term debts. And we all know that what is current assets. Basically, current assets includes inventory, your closing inventory, your trade receivables, your cash at bank, cash in hand, and some advance payments. So if we say liquidity ratios, like previously we were talking about the profitability ratios, and I was telling you that if you are going to calculate the profitability ratio, so there are a lot of ratios we have been calculating for finding profit. So if we are talking about the profitability ratio, so it means that we are going to calculate the income statement sections. And if we are talking about the liquidity ratios, so it means that we are comparing the current assets and current liabilities. We are comparing that, okay, if we have $1 liability, so how much dollar we have as current asset in our within our business, so we can easily pay our short term debts. So the first liquidity ratio is current ratio. So we have a formula to find a current ratio, and the formula is current assets divided by current liabilities. Just remember one thing, that if we are going to calculate the current ratio, so we will add all type of current assets in it. For example, closing inventory, trade receivables, cash at bank, or cash at hand. Okay, but if we are talking about, if we are going to calculate the asset test ratio, so it means that we are going to subtract the closing inventory from the current assets. So we use all type of current assets, the assets which is, you can say, that usable, which we have for 1 year, not more than 1 year. We know that our closing inventory not for more than 1 year, because we have to sell it within a year. And also the same case in the trade receivables, we can not delay our trade receivables more than 1 year, so that is why it is also your current assets. And in current liabilities you have trade payables. So what is trade payables? Basically, trade payables, basically the payables, the obligations which you have to pay to your suppliers within a year. And there are also some accrued expenses, which is also the part of the current liabilities. And if you don't know what is accrued expenses, so you should watch my accrual and prepayments video, and it is uploaded on my YouTube channel, so you can um, go through it, you can watch, and you will better understand that what is accrued and prepaid expenses. Okay, so basically, current ratio indicates company's liability to meet its short-term obligations. Like if we have $1 liability, like for example, we calculated our current ratio and we have answer, which is 2 into 1. It always, we should write it in always in ratio. Okay, so for example, we have answer 2 into 2 ratio 1. So it means that for every $1 liability we have $2 of assets, twice dollar of assets. So it means that business, your company is at good state, and it means that you have enough current assets to pay your liabilities, to pay your obligations. So those obligations are typically paid for using current assets, and the ratios calculated by dividing current assets by current liabilities. So an asset is considered current if it can be converted into cash within a year of or less. Okay, so like we already know that what is the proper definition of current asset, and what is the proper definition of this. We all know that it is very simple, and I already have told you about this. Okay, so now we are going to interpret it. Like for example, if we have um, answer, if we have current ratio 1 into 1 or maybe 2 into 1, so what is the meaning of this, and what is the ideal current ratio should be? Like if we got a specific answer, so how can we interpret it, how can we say that okay, this type of current ratio is very good for our business, and what is the what is the impact of this current ratio on our business, on its profitability, or you can say that on its obligations. So this is very important. So interpretation is very important, and this is the also the part of your syllabus. And whenever you have a question regarding current ratio or asset ratio, so most of the time examiner would ask to you that okay, that like we have this answer, so now interpret this. Okay, so that is why we also should know that how to interpret our current ratios, and like if we have a specific answer, so we should know that how to interpret this, how to analyze its impacts over the business. So the higher the ratio is, the more capable you are of paying off your debts. Okay, like if you have 2 into 1 ratio, if you have 2.5 into 1, so what's the meaning of this? It means that on every $1 liability you have $2.5 assets to meet your obligation. So it is very simple. So if your current ratio is low, so it means that you will have a difficult time paying your immediate debts and liabilities. So in general, a current ratio of 2 or higher is considered good, and anything lower than 2 is a cause for concern. Okay, so if you have maybe higher ratio more than 2 or maybe more than 3, so it is also a cause of concern. What's the meaning of this? Like if we have a very high ratio or high current ratio, so how this is how this basically you can say the disadvantages for our business. It says that because if current ratio is high, it means that current assets are high, according to, you can say that in comparison with the current liabilities. Okay, so it means if current assets if current assets are more than current liabilities, so it could mean that okay, it means that closing inventory is pile on in our warehouse, and we cannot sell it. So that is why we have a high current ratio. So it is also a cause of concern because we maybe as a businessman, we are not able to sold out our inventory, and so that is why we have a high current ratio. So it doesn't mean that we are capable enough. It means that somewhere we failed to sell our closing inventory, we are not capable, we are not eligible to sell our inventory. So it means that somehow it could be you can say that no use of current liabilities. Like if we have okay, we have more current assets, more current assets than current liabilities, but if there is a lot of inventory involved in this, so what's the meaning of this? The meaning of this, that if our supplier came to us and if he want back his money, if he says that okay, that just pay out pay your money, pay my money back till this date. Okay, so we don't have any current asset, we have only inventory, we don't have any cash, and cash at bank and cash in hand. So it means that we have a lot of inventory, so we cannot say okay, we are giving you this inventory. um, um Okay, so we cannot say to our supplier, okay, we are giving you this inventory in return, as in return, instead of cash. So of course supplier will not accept this, because the inventory which we have been using in our business, it basically we purchase this inventory from our supplier. So how could this inventory will be useful for him? Because he also sold this inventory to you, because he also want to earn some cash. Okay, so that's why somewhere if current ratio is more like is higher than 2 or 3, so it means that it is also you can say that alarming situation. Okay, so after that we have asset test ratio. So if we want to just examine closely, if we want to examine, if we want to measure the capability of a business, that okay, if we are closing inventory is the main problem, we cannot convert it into cash quickly. So that's why we are just going into more depth, and we are like we want to see okay, if whether our business is capable enough to pay its short term debts on you can we only consider those types of current assets which are more easier to convert into cash. So that's why we use asset test ratio, because we want to examine, we want to measure the capability of a business more closely and more in depth. So that is why we use asset test ratio. So what type of formula we should use for this? So formula is same basically. We use current assets minus inventory. We have to minus closing inventory from the current assets. So after that we have only trade receivables, cash at bank, some advance payments, and cash at hand, if it is there written in the question. So we have to divide it on the current liabilities. So the quick ratio, also known as the asset test ratio, we can call it by two names. We can also say quick ratio. So the asset test ratio is a type of liquidity ratio, so which measures the ability of a company to use its near cash or quick assets to extinguish or retire its current liabilities immediately. Okay, so like if a supplier came to us, if he want to if he says okay, just I want my money back on the spot. So do our company have kind of capability or ability to pay its short term debts immediately? So that is why we use asset test ratio. So that is why we deducting the closing inventory from this from the current assets. So what is the interpretation for this? Like if we have maybe what type of asset ratio would be ideal for the business, and what type of asset test ratio tells something about the business, and how to interpret this, how to interpret the analysis and the impacts of the on the business of this asset test ratio. So an asset ratio of 1.5 into 1 means that the company has $1.50 of a liquid asset available to cover every 1.0 of current liabilities. Okay, like if we calculate our asset test ratio, and we got to know that we have answer, we have asset test ratio which is 1.5 into 1. So it means that for every $1 we have 1.50 liquid assets available to cover our 1.0 current liabilities. So the ratio indicates that the company is in a good position to cover its short term obligation as they come due. So on the other hand, a very high ratio could indicate, for example, we have more than 1.5 asset test ratio. For example, we have 2.5 into 1, or maybe 2.5 into 2, 3 into 2. So what's the meaning of this? Apparently we can say okay, it is good for business, but it is not the same case. Because if we have more cash involved in the business, which if we have more business, because if we have high asset ratio, so it means that we have a lot of cash which is um, laying idle in the business, and we are not using it. We are not using it for the business expansion. We are not using it for to pay our share to pay our dividends to our shareholders. So this is basically disadvantages for our businesses if we have a high asset rest ratio more than 2 or 3. So, on the other hand, a very high ratio could indicate that accumulated cash is sitting idle rather than being reinvested. Like if we have a lot of cash in our business, so we should reinvest this into business, because business expansion is always, you can say, the main objectives of the business, one of the important objective of the business. So return to shareholders or otherwise put to productive use. Like we should not keep this cash idle. We should use this cash somewhere. We can reinvest this cash into our new projects. We should reinvest this cash into like in maybe some kind of making new products, or like any kind of productive kind any kind of productive activity we can run by using this idle cash. Okay, and we can return, or we can pay the dividend to shareholders. But if we are just kept this cash idle in our business, so it means that we are not capable, our maybe our managerial expertise is not enough, or maybe they are not successful to use the resources successfully.